Waiting until filing season is the most expensive mistake of all. One tax mistake could be costing you thousands every single year. We're breaking down the 5 costly tax mistakes we see most often in high income tax planning and the simple fixes that keep your plan on track. We take complex planning and turn it into simple steps you can use. Welcome back. I'm Mo Piram with Asset Management Group.
And I'm Andrew Nida. And today, Mo and I are going to break down 5 tax topics, subjects that high income earners seem to make a mistake with. It's right here at the end of 2025. And so it's good information to make sure you don't make the same mistakes. But before we get to it, if you like the content in this video, take a moment, subscribe, follow us so you get great, solid quality advice just like this. Mo?
Yes.
All right, man, we're talking taxes. First off, it's hard to believe it's the end of 2025.
Yeah.
I know we say that, but you know, time, man, it just moves.
Yeah, this year just went by really fast. I mean, I just remember the other day, just the summer starting, right? Because my birthday is right in the beginning of the summer. And now we're talking about tax season for us. And, Q4 for us is when we really do our prime tax planning for our clients. But I just can't believe we're already here, right? I mean, you walk down the street, there's Halloween decorations already out. I mean, it's just crazy how fast this year's gone by.
Yeah, what's crazy is what some people do for Halloween.
Oh my gosh, let's not. We should have a podcast about that.
Listen, I mean, you gotta get I get it. You want to have fun. It's the season, Halloween, Thanksgiving, Christmas, but man. And what's crazy to me is I've got some friends too. I'm not knocking it, right? I got friends that have these, 10, 12 foot, however tall those skeletons are.
Yes.
And I'm like, people that have those out there, they're like, that's their buddy. You know what I mean? They're prideful about it. No, but anyway, yeah, man, it's been a good year. A quick push for a video that we did in the past. I just thought about it when you were talking about our season that we're entering into. You and I talked a while back, it may have been over a month ago now, about just the implementation of AI technology into small business.
Yes.
And, we just got through kind of, reigniting some of the systems and softwares that we use and the technology we use in preparation for this big service season for us, which is, tax season. And so, I just throw that out there for all of you guys that may be, maybe small business owners. Man, the technology is incredible. You got to know how to use it. You may have to invest in someone to help you develop it and integrate it into your processes at your business. But the reality is man, it's huge. And I'm just, I'm completely satisfied and excited with what we've been able to do now to enhance the services and a lot of the challenges we faced in years past. So thought I'd throw that out there, push for that video, go back and watch it. Apart from that, 2025 tax season, one of the biggest mistakes that people make is they wait till their tax return. Whether it's high income earners, specifically high income earners, but business owners, they wait too late in the year.
Yeah.
That's another issue. Forget tax returns. They're waiting, till November, December, and time's up. The IRS takes things off the table as the year progresses. And so, just delay is one of the biggest issues.
Yeah. It's, I think the common misconception is that tax planning is tax filing. And then that's all you have to do, right? And then once you figure out what your tax liability is, or maybe what your refund is, well, maybe there's a few things I can do at that point. Maybe there's a deduction here, maybe there's an expense here I can put in, and that'll reduce my taxes by whatever. But that's their mindset of what tax planning is. But tax planning is a proactive strategy that you have to constantly do throughout the year. Now, there's some, the reason for us why tax planning really is the focus on Q4 really is because for most people, by the time you get till October, you kind of have an idea of what your income is going to look like for the rest of the year, right? I mean, if you're a W-2 earner and maybe the only additional income you have is a bonus, well, by Q4, you know whether you're going to get the bonus or not, right? For most people. If you're in real estate, probably the deals you're going to close by the end of the year are in works right now. So you probably know, okay, maybe 3 or 4 more deals by the end of the year. I can kind of tally up what that's going to look like, and we can kind of estimate what your income's going to be. So that way we have a good understanding of your income for the year. But other strategies, you're doing it throughout the year. Well, you should be doing it throughout the year, right? And so, yeah, you're right. I'd say a asterisk of number one is waiting till the end of the year to do your tax planning.
Right.
Waiting till you do your returns to do the tax planning. But I'd say number one, again, we're not ranking this from top to from the most to the worst, from the best to the worst. But I'd say one thing I hear a lot is that when people are looking at their investment strategy, they're thinking they're prioritizing taxes or reducing taxes for their investment strategy, right? So they're letting taxes lead. What's that strategy? What's that word?
I see what you're saying. Right. They're
let the tail wag the dog or something like that. They're letting the
Right.
tax strategy be the first thing they want to look at when it comes to investment performance investment strategies. And I
Right.
think that's a big mistake.
Yeah. Well, I mean, I think it can be. I mean, so this is actually a pretty hot topic. I find this conversation oftentimes with speaking with other CPAs and accountants. Matter of fact, I myself have traveled through various CPA relationships until I found one that was really fitting to our strategy. But that was that was a common statement. You don't need to go into an investment with tax planning being the priority
primary
over
driver.
returns or over cash flow or whatever. And I'll be honest with you, I struggled with that comment. I struggled with it through several relationships, and the struggle was like, okay, well, how can someone say that until they quantify the benefit of the tax strategy? You know, if I give an example, if I decide to, if I get to the end of the year and I'm looking at a tax liability, let's say for a small business owner, they owe the feds $175,000, and we're looking at an investment strategy to reduce that tax liability as a priority. And the business owner sees the benefit of taking of the 175,000, they're going to take 100,000, 150,000 and go and purchase a short-term rental property in Florida. And they're going to create cash flow with that investment. So they go put 150 or whatever down on this property that's valued at 450 or 500. And all of a sudden they have an investment, right? They go and accelerate the depreciation on the investment. They do a cost seg study. They maximize the expenditures of that property year 1, year 2, year 3, okay? As a result, they're now able to create, I'm going to just throw an example, a hypothetical number out there, 275, 300, 325 of extra depreciated cost against the business or their Form 1040, their personal income. And if you take someone who owed $150,000 in tax liability, and you're able to now throw in this major expense of, the number I gave you, around 300,000 or something like that, you're able to significantly reduce the overall tax cost that person has to pay. To give you an example, if that client is in a 35% tax bracket, well, you take 300,000 and take 35% of 300,000, right? You're above $100,000. So, you're saying, okay, I got to give the government 150 over here, or I could put, 150 in a real estate property that I now own and immediately take back what I was going to give the government 100, 110 of the 150. I mean, I think it's a bold statement to make when you're a CPA or an accountant to all the time shift to the bias of, well, don't, everybody's got to pay their taxes. Don't make any tax decisions. Don't make any investments with taxes being your focus. I think you got to pause there and just say, okay, what type of tax strategy am I going to work at? And is it going to be something I try to stick with over time? Or is it just going to be something I try to do for this year? A lot of those questions go in. But I think it's a good point. I really do. Should tax benefit overweight any other part of an investment that you're making?
Yeah.
That's a big question.
It's a big question because even if you use the example you just made, right? So I could pay, I think it was 150,000. I think that was your example, to the government, just wash my hands and call it a day, or do I now become start investing in real estate? That's a big decision, right?
100%.
Because now you're almost a landlord. Now if
You
you are a landlord, right? And if you're doing short-term rentals, now you're in the business of short-term rentals, right? So then there's more than just buying the property in Florida that you mentioned and washing your hands clean. Now you're dealing with a property now,
Yeah.
and so yes, it helps you with your taxes, but now you've created another business for yourself, and so I think that's the decision that individuals need to make for themselves, right? How much does the taxes or the idea of just wiping the slate clean and moving on to the following year means to them versus, okay, I can see the benefit behind it this year, but if I do the depreciation, the cost seg, now I have an investment property that can generate me income, not just this year, not just next year, but 5, 10, 20 years down the road. And there's a lot of value to that. So I think you're right. I mean, I think it's definitely, you have to weigh out the options. What's the best for you? But I think the idea behind don't let the taxes lead the strategy is, well, I'm just going to buy this property. It saves me $100,000 in taxes, and I can just move on. No. There's more that needs to go to it, right? And sometimes, even the simplest versions of, do I invest in my pre-tax 401k? Do I invest in my Roth 401k? Well, the pre-tax 401k gives you the tax deduction today, right? But the growth of that account, there is a question mark of what you're going to pay in taxes down the road.
Right.
The Roth strategy is you pay your taxes today. If you're in the 35% tax bracket, 24, 12, whatever tax bracket it is, you're paying those taxes today. And then, for the future, all of that growth is tax-free.
Is tax-free.
So on a small scale, which one do you choose, right? And there's a lot that goes behind, which one makes the most sense for you. Some years it may be the Roth. Some years it may be pre-tax.
Yeah, it's almost like when it comes to tax planning, there's certain areas that, there's certain areas that can be like financially quantified, right? Yeah, you look like the question you're posing right now. Do I fund the traditional IRA? Do I fund the traditional 401k versus Roth or Roth 401k? Right. That's something that mathematically we can solve for. I think that's something we can do. When you brought up, the whole tax leading the investment strategy, I'm thinking, it's a good point. And I think that's true for really every other investment, meaning, do you let opportunity lead your investment choice? Because just because there may be great opportunity, maybe that great opportunity has a higher risk level because it is a greater opportunity, and maybe you really shouldn't do it because of the risk level and the cost that you can't afford to take. So, I was just thinking, I think at the end of the day, a lot of the clients that we work with, a lot of the high net worth clients that we work with, I think one of the value adds that we have, and the reason we retain and work with many of the families and businesses that we work with, is just taking the time to figure out, like you said, what is best suited for you. Buying real estate's it's a business. Sometimes when we're talking about taxes, it's better just to pay the tax bill for most people, because they're like, hey man, I'm early 60s. I ain't trying to get into real estate. I've been paying the government for 40 years, right? Let me write the check, just get off that off ramp and a retirement call today.
Yeah.
For others, they're saying, look, I got a client right now that comes top of mind. He's a $600,000-$700,000 income earner, household income earner. He has a big future ahead of him if he stays, where he is. Ideally, if it continues its pace. And that's the question he's asking. What can I do? I know it's not just a problem this year. It's a problem for the next 15, 20 years.
Yeah.
Okay. And when you take how much I'm paying the government today, over the next 15, 20 years, I got to start thinking, can I get some of that back? And how? So I think you're right. It's just, it's based off the person, and whatever is attractive about an investment, don't have that knee-jerk reaction, impulse, jump in. Don't jump into oh God, what? What's been going? Oh gosh, the gentleman that had the cryptocurrency that Sam Bankman.
Fried.
Yeah, golly, bum. You know it's back.
What do you mean?
Sam Bankman.
He's back?
No, he's back.
Oh, okay.
His company's.
His company's back.
Yeah.
Really?
Mm-hmm. Yeah.
I didn't know that.
Yeah. I've started to hear it started to pop up. I don't know what's going on in my throat today.
Yeah. Andrew, don't invest there.
Yeah, no, I'm staying away. Yeah. Don't do what your neighbor does. It's not always wise.
I think another mistake is, people treating deductions as discounts.
Yeah.
And what I mean by that is, you ever watch the show? You probably never watched it. Schitt's Creek.
What did you say?
It's SCHITTS.
No.
Oh, it's a
First off,
funny
I don't
show.
watch TV that much. That's my problem.
It's such a funny show. But anyway, and those who watch the show know exactly what scene I'm talking about, where David buys all the skincare and comforters and sheets because he owns a store, but the store doesn't make any money. But he's buying all this stuff, right, for the store, and his dad comes in and he's like, "Where'd you get all the stuff from?" He's like, "Oh, don't worry about it. It's a write-off." and his dad says, like, "What do you mean it's a write-off?" He's like, "Oh, well, I need the skincare so I can look good for my customers. I need to test these sheets because my customers are buying it." And he's like, "Who's gonna write it off?" And David says, "The write-off people. It's a write-off, So I'm doing a bad case for it.
No,
but
that's
those
actually
out
pretty
there, if
good.
you watch it, it's such a funny. It's like a 3-minute clip watching on YouTube. But the whole point is that when people think of deductions, all they hear or they see is that, well, it's just a deduction. There's no big deal. But no, there is you actually do have to think about it.
Right.
And I think one of the misconceptions is, I think it's section 179? 179, where, and I see it all over YouTube, right? Go buy a car, go buy an SUV, right? You can write it off on your business. And it's like, oh, that seems very attractive, but there's actually more to it than just buying a car.
Yeah. Right. Yeah. No, it 100% true, because like when you go and implement like section 179, and once again, you're going to go through makers or accelerated depreciation to try to get that deduction. Remember, you go buy $100,000 truck. Okay. First off, if you can finance it, but let's just for simplicity's sake, say you take $100,000 out of your business and you go buy $100,000 truck, right? In that situation, that $100,000 is gone. Okay. Now the exchange and the benefit is that you get to depreciate this expense that you have. So what it means to your tax liability is that your tax liability may drop $30,000, $35,000, but you just robbed the business from $100,000, right? So you still have to owe, like if you owed the government $100,000 and you went and took $100,000 and bought a truck, you still owe the government 70. Okay, and this is all just hypothetical, but to give you a reference, you still owe the government $70,000, so you owe them $30,000 less. So that's a benefit, but you still owe them 70, which means now you have to come up with not the $100,000 to buy the truck, and then the 70 you still got to pay the government. And yes, you have an asset, not a great one, it's depreciating, whatever. So or losing, value. So to your point, now does it make it a bad idea? No. Right? Because the reality is, if you got a business that's successful and it's sitting with cash flow, it's not a bad idea. I'll flip that story on you as an example. Okay, let's say you take someone who has already has vehicles for the business. Okay, so they're not looking to go and purchase a $100,000 truck. They're looking to purchase that truck, but they have another vehicle worth $60,000 that's already paid for. So they're looking to upgrade, and that's their process, right? Which is what I think is more important for high net worth individuals and business owners, is to figure out what process can you implement season over season relative to present tax laws. And so you take that story, okay, well, guy has a business, owns a truck, $65,000 value. He's going to trade it in, okay? Mm-hmm. All right, so all of a sudden he gets rid of the $65,000 truck. He now has to come up with, $35,000 to cover the gap to get the new truck.
Yep.
Okay. So he's got to come out of pocket with the business $35,000. He can accelerate the depreciation of the value or do makers, like I mentioned before, of the $100,000 truck. He now saves $30,000 in federal liability. Now that story's different, right? He literally just pulled from his operating account $35,000 to save $30,000 in federal tax, and he got a brand new truck. So
different story.
It's a whole different story, right? But the point is I think to what you're making, just because people are doing it, just because you can pop up a YouTube reel, pull it up on Instagram and say, man, that sounds freaking amazing for my business, and I've waited too long. Once again, it's why you got to plan ahead. But it's November. Crap, let's go do something right now. May not be the best option for you.
Mm-hmm. Yeah, no, that's a good point, right? Because I guess there's a psychological trick there where the deductions do add value, right? Even in your first example, there is some value there,
right?
But without understanding all the options that are available to you, without understanding that, yes, in the first example, yes, I get to put $100,000 and I get to reduce my taxes by 30 grand. Yes, there's true value right there, but at what expense? Mm-hmm. Right now, like you said, you just robbed the business of $100,000. Then now you have a truck. You still owe the government now 70 grand, right? So now that whole process actually cost you $170,000,
right?
When it could have just cost you 100 to just to kind of wipe the slate
just
clean.
Be done. And you keep the money in your operating account.
And you keep the money in your operating account. So, there's a lot that goes into it.
I'll throw something else out there real quick because we want to hit this on the individual and the household too, not just business. But so one more thing about the business when it comes to investing with a tax mindset. Sometimes the best decision is to not go buy things that are unnecessary.
Yeah.
Right?
That's the key thing, understanding if it's necessary or not.
Right. So like, for instance, maybe you can go purchase the truck and it does seem like financially it's not a terrible deal, but does the truck add value to your business? Or is it better to go hire another employee or to bonus some of your staff members better or to throw a marketing event or to throw some money, into online marketing or social, whatever it may be.
Yeah.
Right. At the end of the day, plan to, we're talking about business owners here for this one statement. If you're in a business and you can invest money in your business that's going to create long-term value and reduce the overall tax liability, I think that's got to be one of the best things you could ever do, right? For most people that are entrepreneurs, their business is by far the greatest returning investment they will ever have. It's oftentimes the distractions that become the issue. So I think, pause, first go to your business. And then if everything is operating and clicking well, you don't need new technology. You don't need to upgrade your office, give your people new technology and computers or, buy some swag or whatever, then shift to other alternative investments that could help reduce. But that's, for the business, I think that's a great way of thinking about it.
Yeah. I'd say in the grand scheme of things, it's like, would I make that purchase without the tax benefit?
Right.
Like, is that something I would do?
It's a good question to ask.
Regardless. And if the answer is yes, then it's like, okay, now I get an extra benefit behind it.
Yep.
Right. As opposed to, buying all this equipment that you actually don't need. And where you said there could be other strategies like incentivizing your employees or bonusing them or anything of that sort. So, yeah. So I think that's a very costly mistake. Mm-hmm. I think another mistake is that you mentioned Sam Bankman-Fried, but that's a good one where people may be taking high risk just for tax deductions, like investing in things that are more risky than they actually need to be, just because of the tax deduction. And I think of looking at different oil and gas partnerships, conservatives, right? Things that are hard to explain, but there are some tax benefits behind it. But they're probably within your risk profile outside of it, and so you're uncomfortable with the risk. You can't even probably explain what those gas and oil partnerships really are. But you're doing it just because of the tax purpose, just because of the tax benefit.
Yeah, I think if you're considering investments that are what we would call like an alternative asset, right? You're looking at limited partnerships, you're looking at REITs, you're looking at private equity, lending. I mean, I've heard it all. Investing in ATM machines, right? Which offer tax-free benefits, tax-free cash flow. So if you're considering an alternative investment, once again, first and foremost, I think there is some fundamental priorities that need to be in place. Number one, you need to have the heartbeat of your investment operation secure. Okay, meaning that you need to have, your financials. You need to be able to weather a storm as a household. You need to be debt free, right? Otherwise, you need to be able to justify why you're holding debt. There's got to be a reason for it. Then at that point, you need to make sure that your market-based investments are solidified, meaning that the heartbeat, the good thing about the market, it's not like you're just going to, it's going to be the best investment ever, right? The concept, though, is that it's the steady, the consistency, the not a heavy time pull against your life and your, not like real estate or any other investment, right? So it's something you can do. You can do it consistently. Compound interest is your friend.
Very passive.
Time is your friend, right? Very passive. And so you get all of those pieces in order. And then, you're maybe meeting with an investment advisor. You meet the criteria of a high net worth investor according to the government. And at that point, we're looking at alternative investments, right? For that person, maybe you are looking at some of these investments. And even then, I think we've talked about this a ton with some of our high net worth clients. It's like, but where's the value, right? You're going to take a lot more risk. You're going to take a lot less liquidity, meaning that you're literally with a lot of these investments removing your access and control of the cash itself or the investment itself. There's got to be an exchange for that. Mm-hmm. It can't just be taxes and it can't just be returns. There has to be a true packaged value for you to consider an alternative investment like that. And at that point, then we decide. So I don't know where else to go with that.
No, it's good. It's good. It goes back to, what's...
But you shouldn't just do it.
Yeah,
is my point,
what's
right?
the purpose behind it,
yeah.
right? And what's the comfortability of you understanding what you're getting yourself into. Mm-hmm. A lot of the reason why they're alternative in some aspects is because they're not mainstream, right? Some of them are hard to explain. I'd say one of the most typical alternative investments is cryptocurrency, right? Now, you ask anyone who invests in cryptocurrency what it actually is, they may not know. They may know the names, right? They may know Bitcoin, Ethereum, but if you ask them what is Bitcoin? What is it? What is cryptocurrency?
I'm going to say
they may not know exactly.
I'm going to say that 90+% of investors in crypto don't know what crypto is.
Like what it actually is, right?
Yeah.
So again, is it a bad thing? No, it's not a bad thing. Is it a good thing? Who knows, right? All depends on the investor. But when you invest in these alternative investment strategies, like you said, partnerships, oil and gas partnership. Conservation easements, limited partnerships, private equity, corporate debt. Like if you start looking at these alternative investments, the question is, do you actually know what it is? And there are some tax benefits behind a lot of them, if not all of them. But if you don't understand what that investment actually is and how it really fits within the grand scheme of things, just going after that tax benefit in these alternative investments can really be very detrimental.
Look, I'm going to offer just a quick glimpse of transparency and vulnerability. The reality is what Mo is saying is so darn important. Okay, if you don't know what you're investing in, don't invest in it.
Yeah.
Period. Okay. I don't know for yourself, but like for me, I know I've made mistakes and I knew better, right? I know better. I've been told and taught better, right? And at the end of the day, I have went out there on a personal investment, and made decisions in things that, really just the story was heavy, right? And it was constant and it sounded good. And over time I broke and did it, right? Lost it all. And so the point is not all, but all the investment. But the point is, I think what you're saying is so valuable. So when we, coming to a wrap here from taxes and investing and kind of wrapping this whole thought idea of don't let one particular thing, pull the priority and the focus of any type of investment strategy. Ultimately, it has to come back to your plan. It's got to fit well within it, and it's got to make sense overall. Just because someone else is talking great about it doesn't mean you should do it. Just because it's working for somebody else doesn't mean you should do it.
Yeah.
Right? So I think it's a great point.
And there's an IRS term called economic substance doctrine.
Oh.
Yeah.
Enlighten me.
Basically what the IRS says is that they're not only looking to see if the transaction, now this is for like different alternative investments, right? This isn't like, can I invest in my Roth or pre-tax IRA? These alternative investments, they're not only looking to see if that transaction is legal, right? okay, let's say it passes a sniff test of it legal. But what they want to see is whether that transaction actually changed your economic position outside of just tax benefits. And if you don't pass that test, there's a penalty behind it. Yeah. So you have to pay back. I think it's like you have to pay back all the tax deductions that transaction actually caused, and it's like a 20% penalty.
All right, I'm going to play devil's advocate real quick, okay? Because I thought we were going to come to an end, but now you just struck a thought.
Because
Okay.
that actually became powerful in 2010. So it actually is now how. And I don't know where you're going, but I'll just say I don't know how enforceable it is. I don't know like if they're going through fine tooth combs and auditing everyone who goes into these alternative investments, but there is a little bit of a caveat, which is why you don't invest in things you don't know.
Right, true. You don't do that. But you challenged me with a question to start with, which was don't invest don't put your money in an investment when tax strategy is the only focus, right? But now you present the IRS law that prevents people from investing in things that not only is tax the focus, there is no other focus, right? Returns are not there, right? So it's not proven that anything else is valuable other than the tax benefit, right? Yet people were doing it, which proves my point when I feel, or justifies the concept that you can't just say that investing with tax benefits being the primary focus is wrong when the IRS had to create a law to prevent people from investing with tax planning being the focus, right? That just shows that the government's like, hey, we're losing way too much money, right? We need to create a law that's going to like prevent this because they're creating investments just
to avoid the tax.
To avoid the tax, and it's costing us too much money. That's my anyway.
Yeah, that could be. I mean,
that's a good conversation though, and I think to pull it together, whether you're a business owner or whether you're the head of household, you're trying to guide your family well, you're trying to guide your business well, you're trying to make good decisions. The point is, yes, it's at the end of 2025. Are there things that you can do? Absolutely, there's things you can do. Are you limited? Is it cutting the timeline of you can't get a safe harbor 401k up and going now? It's too late. Right? Could you get a family foundation or a nonprofit up and going? Yeah, but you're pushing the time limits here, right? So the idea is what can you buy investment property and remodel it, make it go live, depreciate? Like you're pushing it. So the point is if you're an individual that pays a reasonable amount to the government and you're asking the question, whether for your business or for yourself, do I have to just keep paying this much money? Do I have to just keep handing it over, right? 30, 40% of what I create in revenue, do I have to do that? The answer is probably not, but you do have to take time to figure it out, right? So I think, the golden rule here is, slow down to speed up. Slow down enough because actually you're running at a clip too fast to make good quality decisions. And because of that, what you're doing is creating more revenue just to give it to the government, right? So take a moment to slow down, work on the idea and the strategy and what's appropriate for you or your family. And then let's get ready for next year, right? Yeah. If that's the case.
Love it.
So, all right.
Next week.
Yeah.
We're done.
Appreciate you guys watching in and listening to the podcast show here at Asset Management Group. Once again, if you have any questions, throw them in the comments if you're watching this on YouTube. If not, make sure you like the show, subscribe. We're trying to bring good quality content to you every single week about all areas finance for you to be successful. Thank you again. See you next week.